Hello and welcome to the latest in our series of videos on the global economy. Today, China and the global economy. My name's Charles Seville, I'm co-head of the America's Sovereign team, and today I'm joined by Brian Coulton, our chief economist, and Andrew Fennell, our lead sovereign analyst on China. Gentlemen, let's get started. Brian, perhaps you could give us some context. You could spell out your global growth forecast.
Yeah, it's interesting. All the commentary at the moment is about the downside risks. But it's important to remember the baseline here is actually a very strong global growth picture. On our forecasts, we have world economic growth above 3% for 3 consecutive years, 2017 through 2019. The last time that happened was the mid-2000s, and we would characterise this growth picture as very much faster than long-run growth potential, so peak global growth conditions really, and we expect in our baseline forecast that to continue over the next 18 months. In the advanced countries, the consumer is very strongly supported by labour markets getting tighter everywhere, supporting job growth, supporting consumer confidence as saving rates come down, as job security rises. The private investment cycle still looks strong, starting to see a few cracks in some of the survey indicators, but the dynamics still look pretty good at the moment in the US. The business surveys, even though they've weakened, are still suggesting further strength in business investment going forward. In the Eurozone, credit to the corporate sector continues to have very strong momentum. And more generally, there's pressure on firms to start investing more at the margin as it becomes harder and harder to attract more labour resources because the labour markets are getting tighter. So the consumer's looking good, the investment cycle's looking strong, and then here in the US, we have one of the biggest pro-cyclical fiscal easings in recent economic history. Now that may create some issues medium term for US fiscal flexibility and monetary policy, but in terms of the impacts on global growth in the next 18 months, it's definitely a positive. So the baseline that we're going into these elevated trade risks is a pretty strong one.
Okay, and now a view on the Fed. The Fed raised rates in June, and then more recently we heard Chairman Powell making some optimistic noises at his Fed testimony. So what's our latest view in terms of Fed monetary policy tightening?
The Fed keeps on going with rate hikes. Jerome Powell is sounding pretty confident about the economy. The dip in core inflation that we saw early in 2017, that's disappeared now. Core inflation is running 2.25% above the Fed's target. The labour market is getting tighter and tighter on almost any way you measure it. So if you take the headline unemployment rate, our own forecast for US unemployment, even factoring in a recovery in participation, is it's going to fall to 3.4% by 2019. The last time the annual average was that low was 1953. But it's not just the unemployment rate. All sorts of different measures are showing tightness in hiring conditions. And the Fed can't ignore that. What was interesting, Jerome Powell focused very, very quickly after he got the job, he focused on policy rules. And that's, I think, allowing him to explain why he needs to continue to hike rates, because the economy is above potential, inflation is above target. There's no real reason now why the Fed funds rate needs to be below neutral. So we think the Fed continues to raise rates by further than the market expects, getting to 3.5% by the end of 2020.
And what do you think this means for the rest of the world? What does it mean for the dollar, and how does it all spill over to the rest of the global economy?
Well, as we went into 2017, we were talking about quite a synchronised global growth picture. I think it's become a little bit less synchronised recently. We've actually been upgrading our forecast for the US, downgrading our forecast for the Eurozone recently. So it's getting a little bit more divergent, and we think, leaving the trade risks to one side, that the risks to growth are probably more on the upside in the US, given the strength of this fiscal expansion. So we think the recent strengthening of the dollar has probably got further to go. So in a way, it's not such a kind environment for the rest of the world. You know, we saw the emerging market currency volatility in May. That was partly related to the strengthening of the dollar. We don't really see any let up in the pressure there. We think that there's further upward pressure on the dollar.
Right. And we probably can't go much further without addressing the issue of protectionism. We and the IMF, I think we've said that we think that protectionism is a risk to our forecast. I mean, what are we actually factoring in, and how big a risk is it?
Well, our last forecast published in early June. At that point, we still didn't think it was appropriate to factor in very much into our baseline forecast, because the steel and aluminium tariffs, the initial $50 billion on China, just not really big enough to have a global macro impact. I think we are changing our view. We're getting more and more concerned now about the downside risks. And specifically, there is now a quite clearly defined escalation scenario out there. If we take the threats that the US has been very clear about in terms of an additional 200 billion worth of goods subject from imports from China subject to tariffs, and the Section 232 investigation into auto tariffs, if the US implements those, it's quite a game changer, I think, in terms of how serious this gets. The US imported 320 billion of autos in 2017, so the numbers will just get much more serious. If we take the playbook for the steel and aluminium tariffs, we had the EU, Canada, and Mexico all retaliating within a week with reciprocal tariffs. Now, if we assume that something similar would happen after the US imposed 200 on China and auto tariffs, then we're looking at a shock to global growth that would be really quite serious, at least 0.5% off US growth. So much more material impact if that happens. It's really the auto tariffs, that will be the game changer. If that happens, we would change our forecasts.
Mm. And Andrew, I wanted to bring you in as well. I mean, how much are you factoring in trade protectionism into your China forecast? What are you assuming?
Well, I guess right now, if you just take the $50 billion in tariff at face value, it's not really material for our growth picture this year for China. We still have China. We have China slowing down to 6.6% this year. But the tariffs by themselves, what's been announced, doesn't really materially change the growth picture. But there is a broader narrative out there where, effectively the Chinese since the middle of 2016 have been imposing much more stringent macroprudential measures, and we've been calling for a very long time that this would precipitate a gradual slowdown in domestic demand. And this year we're finally starting to see the effects of that, the effects of these regulatory measures on credit growth and on broader macroeconomic performance. Now, this is exacerbated by the rising trade tensions, and I think from the perspective of the Chinese authorities, in many ways they got a free pass last year. Last year we had this synchronized upturn in global growth. We had a net trade contributing positively to China's overall GDP growth, and it was against that backdrop that they were able to roll out some quite stringent measures on the macroprudential side. And now with some of these trade tensions rising, we've really narrowed that window, and really now we find ourselves in the middle of 2018 in a position where the Chinese policymakers have to make some hard decisions, because if they continue this deleveraging path and these tightening of macroprudential policy, it is going to precipitate a slowdown in growth. I think our baseline outlook for this is really that it's pretty clear to us that the authorities have made a pivot. For a very long time, they were very much focused on the growth target. But after the Central Economic Work Conference in 2017, the leader of the nation and the core of the Communist Party, President Xi Jinping, said that there was 3 critical battles that Chinese policy needed to address over the coming 3 years. The first was basically financial sector stability and this deleveraging drive. The second was poverty alleviation. The third is environmental policy. And so I guess against this backdrop, we think that the playbook that Chinese policymakers are thinking about using this time in the face of these global headwinds is a bit different than in the past. Our baseline expectation is that yes, they'll probably use some measures to cushion growth, but it's not going to take the same form that it did last time. There have been at the margin some easing of monetary policy in the form of RRR cuts, but we haven't seen so far a cut to benchmark interest rates, and interbank funding rates haven't fallen dramatically in the way that they had in previous credit stimulus. So I guess our baseline is that probably the first line of defense, that if policymakers need to cushion growth, is probably going to be through the fiscal channel. It's pretty clear to us that they're already, actually, if you look at the NPC Standing Committee, there's already an amendment out there to basically to cut income taxes. Mm-hmm. And so it looks like they're looking at some revenue side measures on the fiscal side to cushion growth. And perhaps there'll be a little bit of easing on the expenditure side. But I guess our baseline expectations that we're not going to see a credit stimulus in the form that we've seen in previous cycles in China.
So Brian, I just wanted to revisit the issue of tariffs. Have you done any work on the impact of a sort of trade war scenario on global growth and who suffers most? And Andrew, I wanted to bring you in as well and ask, how do you think China would retaliate?
So when we're putting these numbers together, and we make the assumption that the US imposes the 200 on China, impose a 25% tariffs on autos, and then we get reciprocal retaliation. So straight away, EU, Canada, Mexico come back with an equivalent amount affected by tariffs on US exports to those countries. As I said before, we end up with a shock to the US of about somewhere between 0.5% 0.7% off of growth. So it's a pretty big number. And what's interesting about that number is that actually in this specific scenario, the US gets hit harder than China in this scenario, and that's essentially because the US is picking a trade spat with 4 different trading blocs at once who are all retaliating to the US. So in the scenario that we're talking about here, the US is affected by more measures. It's not to say that there wouldn't be material impacts on other countries. We'd have countries that export a lot of autos, like Japan and Korea, quite heavily affected. But the US doesn't get away with this scot-free. It's being hit by more measures in this scenario because they're picking a fight with 4 different blocs that are retaliating immediately. Now, that's not necessarily the base case, but I think it's quite a credible scenario.
Interesting. I guess it's interesting to think about how China might respond. Of course, the $50 billion, they responded in a tit-for-tat type of fashion, but I guess it strikes us as the tone has softened a little bit on the $200 billion threat. And that could perhaps reflect the reality that any response by the Chinese would be another pressure to growth, another downside risk to growth when they already have these domestic demand pressures that are rising. And so I guess the way that we've tried to think about this is, we can all imagine many things that China could do. For example, when they had geopolitical spats with Korea or with Japan in the past, car exports to China declined quite rapidly, right? And there was an issue with the supermarket chain in Korea as well just last year. And so we can all imagine the scenario. The U.S. affiliates, there's more than 1,000 operating in China. They make something like $500 billion in sales every year. And so perhaps low-hanging fruit might be to target those affiliates, but then actually you come to the conclusion that there's about 2 million Chinese people that are employed at these affiliates. And so if the goalpost for policy now is moving away from growth and it's moving towards employment, well, if you target these U.S. affiliates, you might precipitate, some trouble in the employment market. And so I guess that's why we think that the tone is probably likely to have softened. Now, there are areas that probably wouldn't precipitate any spillovers to the domestic economy. And the one that immediately comes to mind is probably services exports. There's a lot of tourists, Chinese tourists that go to the United States every year. There's a lot of people from China that study in the United States, university and graduate school. And I suppose that restrictions on that aspect of services exports probably wouldn't have the same spillovers. But this is all purely hypothetical because we haven't seen any actual response as of yet. I guess maybe one final point is that if they did respond in kind on exports, well, the U.S. exports a lot of agricultural goods to China. They're also high-tech exports, but agricultural products are kind of part of your core CPI, and so that's got to be something at the forefront of policymakers' minds as well.
Do you think that the Chinese authorities have slowed credit growth enough to sort of head off financial stability risks, or do you think they would still need to do more?
Well, it's pretty clear if you look at the broader credit metrics that we look at that, in 2017, we still had broader credit growth faster than nominal GDP growth. Nominal GDP growth was about 11%. Nominal credit growth was a bit in excess of that. So we still see debt levels accumulating across the broader economy, but it was the slowdown was quite pronounced. And I think that the area where you see this the most clearly is in the NBFI sector. If you look at credit to non-bank financial institutions in China, that was growing. If you looked in early 2016, those were growing at roughly 70% year on year, and it's basically come down to zero. So there's been a broader de-risking and a shortening of credit chains in the financial sector at the same time that we've seen credit growth to the real economy actually quite broadly stable. And it's actually pretty consistent with what the CBRC had been signaling. They didn't want these macroprudential measures to slow down credit growth to the real economy. They want credit growth to support real economic activity. The real concerns that they had was that credit growth was finding its way into speculative activity and it wasn't actually supporting real economic activity.
So you've said you think the Chinese won't relax monetary policy. Would they allow a devaluation of the yuan? Would that help?
So I guess informing our view that we think the playbook for supporting growth is going to be a bit more nuanced this time is that, I mean, there is an external concern. It wasn't all that long ago that we were talking about a capital outflow problem in China. Now, if you take Brian's view on global monetary policy, it's pretty clear that we have the Fed tightening, continuing to tighten. And so the signal to the market, if the rest of the world is tightening monetary policy and China's loosening policy, could potentially be destabilizing for the capital outflow picture. We also don't really see the currency as a lever to basically stimulate growth. Number one, the authorities work quite hard to basically get the market focused on a broader basket to manage the currency. And so if they threw that out the window, I think you'd basically be destabilizing currency expectations in the country. So I think if you look at the recent movements of the currency, a lot of market participants have been asking us what we think about the currency. And I have to say that, broadly speaking, it looks like they're continuing to manage against the basket. The governor of the PBOC, Gong, just went out on state media and said, this basket's been working for us and we're sticking to it. And so the recent movements, I think, in the currency, I mean, it is true that it's depreciated quite sharply against the dollar on a bilateral basis, but really it looks like they're back to kind of a 2-year average on the broader basket. So they just kind of let the air out of the tires on the currency. At least that's our view for now. Now, if it continues to move in a different direction, we'll have to reassess that view. But for now, I think it looks pretty clearly to us that they're managing against the basket.
Great. Andrew, thanks very much. Brian, thank you. And thank you for joining us.